Hey guys, how are you? News of today. Quick update on the market hyper. Yep, don't forget, hit the like button right now. Don't forget to share. Help us grow our channel. It's always appreciated. So what's going on in the UK? UK inflation hits 40-year high, 9%. That is a single percentage point off double digits according to their numbers. We know the US is at 8.4% after a 0.7% core CPI number in and around on their numbers. Shadow Stats, which was the 1982 Ronald Reagan versions, actually has them at 16%. So you are in a hyper-stagflationary environment. We coined the phrase, this is stubbornly high, in truth double-digit inflation, but declared just sub-double-digit inflation of 8s and 9s. UK at 9. One of the key points about that is higher than America. So by the dollar being driven up on the Fed's differential to other central banks quantitative tightening in June, 1 month away, that they declared at the last meeting, plus half-point rise, they are diverging from the likes of the Bank of Japan. They are diverging from the likes of the ECB. What this does is they are stopping the flow of dollars offshore to international. And that leads to a shortage of dollar and the rise in dollars. Why? Because America is a consumer of product. It's a consumer economy generally. That doesn't mean they don't make things and export some things, and there's services that get exported as well, but they're a net global consumer, and they generally export dollars for payments to China, for payments to Korea, for payments to Japan, to Germany, etc., for Mercedes, Toyota, Samsung products going the other way. What that means is by killing the consumer and by tightening the rates really, really hard, they crash the stock market, they have a reduced wealth effect. This is the converse of the super sunlight of the Greenspan era. They kill the property market, which sees asset prices go down because fixed rate mortgages are getting ever more expensive for a 30-year deal. The reduced wealth effect sees consumers spend less, they have higher payments on their cards, their mortgages, and every other aspect of their business. So the American consumers stop spending. That sees a shortage of dollars being exported for purchases of products going the other way. What does that lead to? Well, they will slow to a degree the rate of inflation, although anyone calling peak inflation, it's the new transitory inflation. You are not at a peak. Oil prices are telling you that they're not going down. Energy is a big, big driver. That's why they've got this guy tightening the radiator in the UK, which is typically use gas heating to heat the water. So energies are stubbornly high. We'll show you those gas and charts and oil charts in a minute. But the key element of this is, as part of that process, by not wanting the inflation number to get too far ahead in America, they are exporting, instead of dollars, they're exporting the inflation number to all the other currencies, because against the dollar, the pound is down, the euro is down, the yen is down, the Korean won is down, you name it, they're all slipping down. So what that means is, when you're buying in dollars, is that those other nations now are picking up some of your inflation because you've strengthened your currency. So the export is inflation from America to everywhere else. Of course, the central bank was the one, the Fed, that printed 7 trillion in the CARE Act. Some of that went internationally as well, that created this mega inflationary bubble. What are going to be the usual chestnuts that they're going to roll out? Oh, we're going to tax these profit-making oil companies and gas companies. Oh, why don't you tax a coal miner as well? Why don't you tax uranium? Why don't you tax everything in energy? And hold on, it's not just energy that's gone up, it's food. Why don't you tax farmers? Agris have gone up. Why don't you tax everybody? Guess what? It's a central banking cartel created inflationary cycle. They do this because they want to impoverish the middle class, they want to impoverish the poor, and they want to absolutely make the billionaire class super wealthy, who have huge amounts of debt which they've borrowed at super low amounts to buy assets. Those assets go up in price with inflation, the debt gets deflated away, they themselves are hyper indebted. This is how they manage a debt situation. And even though there are rate increases, they are well behind the actual cost of the inflation rate currently in the market in truth. So all of this, oh, we're taking the edge off inflation, that's why we have to tighten the rates. No, you're not. If inflation is 9%, rates should be 12%, 11.5%. They should not be 1%, 0.75% or 1.25%. But of course, as they tighten rates, they will all be impoverishing the consumers of all major nations. This will lead particularly to the producer nations, a lot of them in the East, having a major severe recession. In fact, this is depressionomics, this is hyper-stagflation, essentially depression levels of economic growth following the deglobalization, the increase in prices, all because they wanted to provoke Russia in 2014 with regards to the flippening of Ukraine. That's now led to a fragmentation, driven Russia into China's arms, and here you now go. So China is keeping a lot of ships in ports, major lockdowns, is trying to reduce supply so that they can hold pricing power. Because if you're getting such a reduction in demand, typically what happens in your demand and supply curve that runs like that, the higher the demand, the higher the price. The lower the demand in a recessional environment with super high interest rates potentially on the cards in terms of A, your inflation reducing the disposable income, and B, the rates cycle turning up. We called the turn in the debt market a long time ago. Other people now waking up to this fact. What you end up getting is they want to reduce the supply so that they don't have excess supply and have a glut, which will see an absolute crash in prices. So that's why you will see Shanghai-based lockdowns. You will see in the name of the thing that we dare not mention that initially made its debut in March 2020. And as you're seeing the same also in North Korea, I wonder if that will extend to South Korea. Lots of other aspects that are going to be supply reduction. So you're going to see the demand curve get tighter and smaller, and you're going to see the supply curve attempt to move down with it. This is a contraction then, because you make less is being bought, and you're trying to hold the same price levels because the demand side is looking to reduce inflation, aka the Fed, in terms of its consumer. By killing its consumer, by killing their disposable income, they will buy less, they will pay more in debt payments. The supply side, if we characterize that as being, say, China, they will not want to see that price go down. So they will try and match the reductions in demand to reduce supply. This is how you engineer these events so that it best suits your macroeconomics of what's going on. Is the Fed really fighting inflation? Well, if they were fighting inflation, they would already be at 10% interest rates today. They clearly aren't. We can't find 2% inflation to we're above 2% inflation to it's transitory to it's not so transitory. They now be calling peak inflation, and they're still only at 1% inflation. They will start tightening. That's even more damaging when they start tightening. And this doesn't end well. This is a stock market crash. This is going to continue. We have called the head and shoulders. There's people still waiting for blow-offs. Only get upside move after extreme pain, and they're going to hold the pain for longer this time. Why? Because the dollar and the Fed is not truly initially trying to fight inflation. It is trying to fight dollar dominance. There are new currency systems following the loss of Russia's 500 trillion that was frozen. There are new alternative courses of action that have been taken by the non-cool nations that are not Western friendly. And as a result of that, the dollar wants to meet their launch with fire, as it did the euro, with real dominance. The euro, after being released well above the dollar, ended up crashing to 80 cents as it was going into its release. It was the silverback gorilla of the dollar, showing it is the dominant and the biggest of them all. And right now, as it fears these other systems coming into play for the Russians and the Chinese to do business, whether it's yuan, ruble, central bank digital tokens, gold and oil-backed currency type mechanisms, what they will seek to do is create so much demand for dollars because of the momentum. People chase and follow momentum. If you're getting paid more interest in America than you're being paid in Europe, and the dollar is going up far faster and the euro is going down, you as an oligarchical Amazon with a massive treasury department will hold more dollars and less euros, yen, and other currencies. As a result, there will be a pivot. There is almost the seesaw relationship in the West in terms of the euro and the dollar. What's good for the dollar is bad for the euro. What's good for the euro is bad for the dollar. It's almost binary. It's one and the other. What you'll actually see is a steady move out of the euro, which is going to continue to see currency devaluation and push eurozone-based inflation. So if you think this is just a UK article article. Wait and see how you will be getting bigger numbers out of Euroland than America and the UK, especially when you add gas prices. A super quick look at the charts, and then we're concluding this very quick hit on the markets. Natural gas, let's have a look at it. We'll leave Bitcoin, our friend that is languishing there for a bit, and we'll go down to the energies, and here they come. Moving up, so you're staying stubbornly above the 100. Looks like there's room for it to have a little bit of a pullback, slightly lower down as these big inflation scary numbers hit, but I don't see it staying down for too long. You're still in and around the 110 levels. You've broken out over here. You've made a higher high. You've got a succession of higher lows and a succession of higher highs in this period over here. This is not a long term, and this might come a little bit on the back of the threat of special taxes on the profiteering taxes on the oil companies. They bring this one out every single time, as I say, and it's a standard trick of government making sure these nasty corporations. Central bankdom did this. I'm no friend of the oil cartel at all. It's the seedling of Rockefeller, but I can tell you that this is a fiat-based problem driven by central bank proliferation following the events of March 2020 and creating 7 trillion. They've created an asset bubble that is now being deflated. They've created inflation, and they have created a shortage of energy providers after dipping oil, which we predicted to single digits that no one else saw. And as a result, now with the proportionate spill to the downside of the oil market that occurred, you get a similar geometric level of pump to the upside. And this is causing real problems. Energies is in the cost of everything. Okay, guys, that's your quick news flash. Britain at 9% inflation. Britain at 9% inflation, higher than the US. US is ceasing to export dollars and is now exporting pain and inflation by strengthening its currency. The dollar dominance will continue. You will have a melt up once more nation states realize it, a rush into the dollar. Beware, beware, beware. The peripheral fiats will start to fail, and there will be debt-based issues. The debt markets and the currency markets are absolutely correlated. They are the release valve for the debt markets, the currency markets. Till next time, please give us a share and a like. Thank you for watching. Go to themarketsniper.com. We will never engage with you in comments, Telegram groups, or anything else. You can only engage with us through our website. Book a call, have a chat. It costs absolutely nothing. We'll talk to you later. Thanks for watching.